Welcome back to Report of Silver, your trusted source for gold and silver market analysis, where we break down the latest developments in precious metals using simple language and clear facts. If you follow silver closely, today was one of those days that gets your attention very quickly. Silver took a serious hit. It dropped sharply, falling more than 5% earlier in the trading session before recovering slightly near the market close. That kind of move naturally creates fear in the market. Investors immediately begin asking two major questions. Is this just a normal correction after silver's incredible run toward $90 an ounce? Or is this the beginning of the end for the silver rally? Those are exactly the questions we are going to answer in today's analysis. Let's begin with what actually happened. Silver opened under pressure and selling accelerated quickly. At one point, the metal dropped to around $83.11 after recently trading near $88.55.
That is a sharp move lower in a very short amount of time. By the time markets were approaching the close, silver was still down nearly 5%, settling near $83.42. That is a painful move, especially for traders who entered the market near recent highs. But before panic takes over, we need to understand something important. Large moves like this often happen in bull markets. In fact, strong markets regularly experience violent corrections. They shake out weak hands before moving higher again. Now compare silver's performance to other metals today. Gold was also down, but much less, falling less than 1%. Platinum and palladium were also weak, both losing more than 3%. But silver was the hardest hit. That tells us silver was the focus of profit-taking. It was the strongest performer recently, so naturally it became the biggest target for short-term selling. This widened the gold-to-silver ratio back to around 55.88. That ratio is still historically supportive for silver, but it does show silver gave back some of its recent outperformance. So what caused the sell-off? The answer centers around the Federal Reserve. For months, markets were expecting interest rate cuts. Investors believed the Fed would eventually lower rates to support economic growth. Lower rates are usually bullish for precious metals because they weaken the dollar and reduce the opportunity cost of holding non-yielding assets like silver and gold. But now that story is changing. Markets are beginning to believe the Fed may not cut rates at all in 2026. In fact, some traders now think the opposite may happen, that the Fed could actually raise rates again. That is a major shift in expectations, and markets reacted immediately. When we look at the current Fed probabilities, the message is clear. At the next meeting, almost nobody expects a rate cut. By July, expectations are still overwhelmingly for no change. But by September and October, the probability of a rate hike starts increasing. By December, more than one-third of market participants believe the Fed could raise rates by a quarter point. That is a dramatic change from just 1 month ago, when almost nobody was discussing higher rates. Why does that matter for silver? Because higher rates strengthen the US dollar and usually pressure precious metals. Silver, being more volatile than gold, often reacts more aggressively. That is what we saw today. But here's the key question. Does this mean silver's bull market is over? Not necessarily. Sometimes markets overreact to changing expectations. Emotional selling can create short-term panic, but that does not always change the long-term trend. And that is exactly why today's move matters so much. It may look ugly on the surface, but sometimes sharp corrections are not signs of weakness. They are signs of a healthy market resetting before the next move higher. To understand why silver dropped so sharply today, we need to focus on one word: expectations. Markets do not move only on current events. They move on what investors believe will happen next. And right now, what investors believe about the Federal Reserve has changed dramatically. Just a few weeks ago, many traders were convinced that the Federal Reserve would eventually begin cutting interest rates. That was the dominant market story. Inflation looked like it was cooling, economic growth appeared to be slowing, and many believed lower rates were only a matter of time. That outlook was one of the reasons silver climbed so aggressively toward $90 per ounce. Investors were positioning early for a more supportive monetary environment, but today that belief was challenged. The market is now pricing in a very different scenario. Instead of asking, when will the Fed cut rates? Investors are beginning to ask, could the Fed raise rates again? That is a massive shift. And markets hate surprises. Let's look at the numbers. At the next Federal Reserve meeting in June, only a tiny percentage of investors believe rates will be cut. The overwhelming expectation is that rates stay exactly where they are. That is not new. Markets have already accepted that. But the bigger story starts later in the year. By the September meeting, the market begins showing something new. A growing number of investors now believe the Fed may raise rates by 0.25%. That probability grows further into October, and by December, more than 34% of market participants believe a quarter-point rate hike is possible, while some even believe a half-point hike could happen. That is a major psychological change. Why does this matter so much for silver? Because silver is highly sensitive to interest rate expectations. Unlike stocks, silver does not pay dividends. Unlike bonds, it does not pay interest. Investors often buy silver when they expect lower rates because holding silver becomes more attractive compared to interest-bearing assets. But if rates stay high or go higher, that changes the equation. Suddenly, cash looks more attractive. Bonds look more attractive. The US dollar strengthens. And when the dollar strengthens, precious metals usually struggle. That is exactly what happened today. The market suddenly realized that rate cuts may be off the table for all of 2026. Once that realization hit, traders rushed to reduce risk. Many short-term silver traders locked in profits. Some automated trading systems likely added selling pressure. That created a fast downward move. But here is where smart investors slow down and ask a better question. Does this change silver's long-term story? The answer may be no. Yes, higher rates can create short-term pressure. That is real. But silver's bull case has never depended only on rate cuts. Silver is supported by multiple long-term drivers: industrial demand, global supply shortages, central bank concerns, geopolitical uncertainty, and strong physical buying from countries like China and India. None of those factors disappeared today. In fact, China continues buying large amounts of silver. Industrial demand remains historically strong. Silver is now officially recognized as a critical mineral in the United States. Physical supply remains tight. So while today's move looked painful, it may simply be the market adjusting to a new interest rate reality, not abandoning silver entirely. There is another important factor. Markets often overshoot in both directions. Just as silver may have moved too quickly toward $90, today's sell-off may also have been too aggressive. Emotional markets often create short-term extremes. That is why corrections can feel dramatic, but they do not always mean the trend has changed. The key now is support. Silver is still holding above a major technical area near $80. If it stays above that zone, many analysts will still consider this a healthy consolidation inside a larger uptrend. And that leads us to the next question. What are the charts telling us? Now let's move from headlines to the charts, because this is where we can separate emotion from reality. When silver drops sharply like it did today, many investors immediately assume the rally is over. But technical analysis often tells a more balanced story. Sometimes what looks scary on the surface is simply a healthy correction inside a much bigger uptrend. First, let's look at the most important level right now, the 20-day exponential moving average, which sits near $79.66. Why does that matter? Because this level acts like a dynamic support line during strong uptrends. Think of it as the market's floor. As long as silver stays above that level, the broader trend is still considered bullish by many professional traders. Right now, even after today's sharp drop, silver is still trading well above that support area. That is important. Yes, the market was hit hard. Yes, sentiment turned negative fast. But silver did not break its key trend support. That tells us this may still be a correction, not a collapse. Now let's talk about momentum. Before today's sell-off, silver's relative strength index, or RSI, was approaching overbought territory near 68. That means silver had been rising so fast that it was becoming stretched. In simple terms, the market needed to cool down. That is normal. No market moves straight up forever. Strong bull markets often pause, pull back, and reset before continuing higher. That may be exactly what we are seeing now. Another major psychological level is $90. This was becoming the big target everyone was watching. When markets approach a major round number like that, traders often take profits. Why? Because psychological resistance matters. Many short-term traders sell near big numbers. That creates natural pressure. Silver came close, but did not break through. That failed breakout likely triggered some selling. Once silver began moving lower, stop-loss orders were probably activated. Those automatic sell orders can accelerate declines very quickly. That is why the drop looked so dramatic. But now comes the important question. Where could silver go next? There are two likely scenarios. Scenario 1. Healthy consolidation. In this case, silver continues pulling back modestly, perhaps toward $80, maybe even $78 or $77, and then stabilizes. Buyers step back in. Confidence returns. The market begins building energy for another move higher. This would actually be the most normal outcome in a bull market. Scenario 2, deeper correction. If silver breaks below that key $79 support area and stays there, then the market may enter a larger correction phase. That could push prices lower and force investors to reconsider short-term bullish expectations. At this moment, scenario 1 still appears more likely. Why? Because the broader fundamentals still support silver. China continues accumulating physical silver. Supply remains tight. Industrial demand remains strong. Global uncertainty is still elevated. None of those major drivers changed today. Now let's add one more factor: market positioning. The COMEX recently lowered margin requirements. That means traders can enter positions more easily again. This increases liquidity, but it can also increase volatility. Large hedge funds, institutional traders, and algorithmic systems can move in and out more aggressively. That creates sharper moves, but it can work both ways. The same system that pushed silver down today could help push it back up quickly if sentiment changes. There is also the issue of Friday trading. Many precious metals investors know about the so-called Friday smackdown, a pattern where metals sometimes weaken going into the weekend due to profit-taking and reduced risk appetite. Could that happen tomorrow? Yes, absolutely. That is why caution still matters. But if silver holds this current zone and buyers defend it, that would send a strong signal that this rally is not finished. Now let's step back and look at the bigger picture, because this is where many investors make mistakes. They see one bad trading day and assume everything has changed. But in reality, the bigger silver story may be stronger than ever. Today's sell-off was driven mostly by short-term market psychology and changing interest rate expectations. That is important, but it is not the full story. Silver is not moving only because of the Federal Reserve. There are much larger forces driving this market, and those forces are still very much alive. The first major factor is China. China continues to buy silver aggressively. This has become one of the most important stories in the silver market. China understands something many investors are just beginning to realize. Silver is not only a precious metal, it is a strategic industrial metal. It is critical for electronics, solar panels, batteries, defense systems, medical technology, and artificial intelligence infrastructure. As the world becomes more digital and more energy dependent, silver becomes more valuable. China knows this. That is why they continue accumulating large quantities of physical silver. And when one of the world's largest economies keeps buying, that creates a strong, long-term floor under prices. The second factor is global supply pressure. Silver supply is tight. This is not speculation. It is confirmed by industry reports. The world has been using more silver than it produces for several years now. That means inventories are being drained. Above-ground stockpiles are shrinking. Every year that continues, the problem becomes larger. Think about it this way. If demand stays strong and supply keeps falling short, eventually something has to adjust. And usually that adjustment happens through price. That is why long-term investors are not panicking today. They understand that one red day does not erase a multi-year supply problem. The third factor is critical mineral status. The United States recently added silver to its official critical minerals list. That was a major development. Governments do not label metals as critical unless they believe they are strategically important to the economy and national security. That move confirmed what silver investors have said for years. Silver matters. It matters for clean energy. It matters for military systems. It matters for advanced technology. And now governments are openly acknowledging that reality. That creates long-term institutional support. The fourth factor is geopolitical risk. Even though markets reacted today to interest rate fears, global tensions have not disappeared. Energy markets remain unstable. Trade negotiations remain uncertain. Tensions between major powers still exist. These risks matter because they create demand for hard assets. When uncertainty rises, investors often move toward gold and silver. That demand may not appear every day, but it remains in the background. Now let's talk about something many investors overlook: market sentiment. Silver recently climbed close to $90 per ounce. That alone tells us something powerful. Markets do not move toward major breakout levels unless there is strong underlying demand. Yes, it pulled back, but corrections after big rallies are normal. In fact, they are healthy. They remove excess speculation, they reset momentum, and they often create new entry points for long-term investors. This is why experienced silver investors often view sell-offs differently than new investors. New investors see panic. Experienced investors see opportunity. That does not mean silver cannot fall further. It absolutely can. A move towards $78 or even $75 is still possible, but those levels would not automatically destroy the bull case. They would simply represent deeper consolidation. The long-term trend remains intact until proven otherwise. And right now, the bigger story still supports silver: strong physical demand, tight global supply, government recognition, industrial growth, central bank concerns, geopolitical uncertainty. That is a powerful combination. In Part 5, we will answer the final question: what should silver investors do next, and how should they think about risk and opportunity from here? Part 5. What should silver investors do next? Stay calm, stay strategic. So after a day like today, what should silver investors actually do? That is the most important question. Whenever silver falls sharply, emotions take over. Fear rises. Social media becomes louder. Some people start saying the rally is over. Others call it a buying opportunity. But smart investing is not about reacting emotionally. It is about understanding context. And the context right now says this: silver had a painful day, but the long-term story is still intact. Let's be honest, today hurt. A 5% drop in one session is never fun. But if you have followed silver for years, you know this is normal behavior. Silver has always been volatile. It moves faster than gold in both directions. That is why many investors love it and why many investors fear it. Silver can rally hard. Silver can also correct hard. That is its nature. So the first thing investors should do is stay calm. Do not let one red day force a bad decision. Ask yourself, has the long-term reason for owning silver changed? Has global supply suddenly increased? No. Has industrial demand disappeared? No. Has China stopped buying? No. Has silver lost its critical role in technology and energy? Absolutely not. That means the core investment case remains strong. Now the second step is stay strategic. If you are a short-term trader, your strategy may be different. You need to watch support levels carefully. Right now, the market is focused on the $80 area. If silver holds above that zone, confidence may return quickly. If it breaks below it, more weakness could follow. That is short-term thinking. But if you are a long-term investor, today may simply be part of the journey. Many experienced silver investors use corrections to build positions gradually, not all at once, not emotionally, slowly and strategically. That approach reduces stress and improves discipline. Now let's talk about risk. Yes, risks remain. If the Federal Reserve becomes more aggressive and starts discussing rate hikes, silver could face more pressure. If global tensions suddenly ease and energy prices fall sharply, silver could pull back further. If speculative money exits too quickly, volatility could increase. Those risks are real, but risk exists in every market. The key is balance. Do not overexpose yourself. Do not invest money you cannot afford to leave untouched. And always understand your time horizon. That matters. Someone investing for 10 years sees today differently than someone trading for 10 days. Now let's talk about opportunity. Sometimes the best opportunities appear during moments of fear. When silver was running toward $90, many people were excited, but they were also late. Now after a sharp correction, fear replaces excitement. That is often where opportunity begins. Not always, but often. History shows that silver's biggest rallies usually include painful pullbacks before the next move higher. That is how markets test conviction. They force investors to decide what they really believe. Do they believe the story or only the recent price? That is the real test. My view remains simple. Silver still has powerful long-term support. Supply remains tight. Demand remains strong. Governments now recognize its strategic importance. Institutions are watching closely. Global uncertainty remains high. Those are not short-term headlines. Those are long-term drivers. Could silver fall more? Yes. Could it consolidate for weeks? Absolutely. Could it move back toward $90 again? Very possible. That is why patience matters. The investors who usually win in silver are not the ones who react fastest. They are the ones who stay disciplined. So my final message is this. Do not let one difficult day change your long-term perspective. Watch the data. Watch the support levels. Watch the Federal Reserve. But most importantly, watch the fundamentals. Because in the end, fundamentals always matter more than fear. This is Report of Silver.